This is a course on option concepts, and there's an assumption that some of you know something about options. There's also an assumption that none of you know anything about options. So while this might be overly review for those experienced option traders, I'm going to ask you to still listen very carefully. There's little minutia and details that generate the massive returns that we're able to do with penny-priced options. So, if you think you know options, listen carefully for the new concepts, and if you don't know anything about options, listen carefully for all the new concepts. We're going to be risking pennies while controlling thousands. Stocks and options, they're similar but different. People have a hard time when I say that I hate stocks. They say, wait a second, you trade stocks for a living and you hate them? Love-hate relationship? What's the deal? I said, well, see, stocks are just but a necessary evil to me. I trade options. But before we get into options, I want to tell you what a stock is. Right? A stock is ownership in a corporation. It's represented by shares designating a piece of the corporate's assets. Right? You might own a fraction, a small fraction of a company. Your stock certificate is the proof of ownership. Now, the purpose in owning stock is to partner with other investors and the business to participate in the earnings and growth of that financial venture. Many people buy stocks to get a return on their investment. The two types would be a dividend, which is a payment of capital to the shareholders. It's sort of like profit sharing. The other reason to own stock is for growth in price. And without a dividend, stock values are one-dimensional, price. Unless you collect a dividend, unless you're paid to own that stock, the only reason to own that stock is because it goes up in price. But if it goes up in price and you don't sell it, you're not making any money. You may be building wealth, but you're not making money. Our system is to build wealth by making money. We're going to put money at risk. Understand that money invested in a trade is money at risk. If you buy a stock, it could drop in value. I can't think of a single stock that only goes up in price. But maybe a bigger risk is that if you don't invest money, if you have all your money on the sideline and you don't buy a stock, the stock could rise in value and you don't participate in it. Those are the risks for owning stock or being a stock investor. Here's the rewards. First of all, the stock can increase in value. The stocks may pay dividends, but most important, the stocks may offer an additional opportunity. That's the opportunity we're going to talk about here. That opportunity is options. Options give you control of a stock with all the expense of ownership. Now, specifically, the advantage of options include leverage, being able to use a small amount of money to control a lot amount of money, the fixed amount of risk. You can never lose more than you invest in option buying strategies. Options are freely traded, especially the options we look at, very liquid. You could use options for portfolio insurance, and there are many ways to profit. The most advantageous aspect of options is the leverage. A small move in a stock will get a larger move in the option. When stocks move, options move faster. The risk is limited to what you pay for the option. This is known as the premium. Now, it is possible to lose 100%, so never put too much in any one trade. Again, options are freely traded. 40 years ago, when there was not an exchange to trade options, you only could buy options from put-call dealers. And your choice was to sell it back to the guy you bought it from if you didn't exercise it. That's not anymore. Now you can convert your option into a stock position, both long or short, or trade it on one of many exchanges. Options can be used as portfolio insurance. Right? They can minimize your risk against catastrophic events to the market or to your stock. Again, they can be used for specific stocks or systemic against a market move in whole. Now, the neat thing about options, you don't need a stock to go up in price. It becomes very efficient to profit when a stock goes down in price. And there are option strategies that allow you to make money in sideways markets. Now, this might seem scary to some of you, but options are derivatives. Right? Derivatives, ooh, scary word, derivative. No, I don't think so. Derivative is just a mathematical term. See, options have no value in and of themselves. Their value is derived from formulas. This aspect being derived from a formula, this is the basis of our system. You see, options take into consideration the stock's price, the amount of time that that option has before it expires, the stock's past and expected movement, and any dividend and then the current interest rate to come up with a price of the option. Options specifically are a contract between buyers and sellers. These formulas, these are not some of the time, most of the time, these are always. These are laws, these are rules. We're going to get into this formula later on in the course. You will see the statistical advantage that we get understanding these formulas. The formulas, that's for another section of the course. Let's talk more of the specifics of options. Options are a contract between buyers and sellers. And as a contract, there are certain rights and responsibilities. It's all written out in the contract. Now, options will control 100 shares of stock. There are a few exceptions to this rule, but this is the generally accepted rule. Options will have a fixed price, known as a strike price. They will have a fixed time. This is known as expiration. And options cost money. This is known as premium. Now, options give the right, not the obligation. The right, not the obligation, to buy or sell an asset at a specific price on or before a given date. The key words, if you listen carefully, were rights and obligations. Let me get into it further. There are two sides to a transaction. Buyers pay to the sellers, and buyers get a right. Sellers collect from the buyers for an obligation. Initial sellers are also known as writers. This course will focus on buying options, buying a right. When we sell that right, we're not obligating ourselves, we're just giving up that right. Now, there are two types of options, call options and put options. Let me start with call options. Calls increase in value as the stock rises in price. Calls drop in value as the stock drops in price. Because of this, a call option is a substitute for buying stock. Now, the buyer of a call option has the right to buy the stock, the right without obligation to buy the stock at a set price, the strike price, anytime prior to the expiration of that option. Now, the initial sellers are obligated to provide the stock at the strike price anytime until expiration if the buyers choose to exercise their right. Again, the strategy in this course is to buy options, and when we sell them, not to become obligated, but to give up our rights. So since a call buyer has the right to buy stock at a predetermined price within a predetermined period of time, it's basically a bet that the price of the stock will increase. Remember, call up. Now, puts can be a little complex to someone that's new, and it may take a little bit of extra time. It's okay if you don't understand them at first. If you need to, just focus on call options. Concept behind puts isn't that difficult, and if you're having a little bit of trouble, you will have your aha moment, and then you'll say, oh, that's actually fairly easy. Basically, it's just the inverse of a call. Puts increase in value as a stock drops in price, and puts will go down in value if the stock rises. It's the exact opposite of a call. Well, exact opposite in direction you want it to move. It's the same basic concept. The buyers have the right, not the obligation. The buyers have the right. But instead of to buying a stock at a strike price prior to expiration, they have the right to sell the stock at a strike price at any time prior to expiration. And people who sell a put that they have not previously bought, they're basically obligating themselves to buy the stock at the strike price anytime prior to expiration. The put buyer has the right to sell stock at a predetermined price within a predetermined period of time. You could say that a put option is a bet that the stock will drop in price. So as we say call up, we also say put down. One more aspect of puts. Puts are a way to insure the market. See, if you own a stock, you can buy a put option, sort of like an insurance policy, that if the stock drops, it's not dropping on you because you can sell it to somebody that's obligated to buy it from you. Contract details. Cost. Options cost money. This is known as premium. Options give you the right to buy or sell at a set price. This set price is known as a strike price. Options are a fixed time investment. They will cease to exist at a point in time. You have to exercise your right or you lose it, and this is called expiration. Going into details, cost or premium. It's quoted in dollars and cents. It's quoted per share, and you multiply it by the number of shares in a contract, and then you would multiply the number of contracts, and then you would get your net price. Quick example. If you see an option that's quoted at 25 cents, that's 25 cents per share, 100 shares per contract, that would be $25. If you bought 2 contracts, it's $50. See, it's not a lot of money to control a lot of stock. The option premium, well, there's a formula that determines its value. And the formula is maybe less based on the stock and more based on the people buying the option. I think it's more of a psychology thing. I believe it's more dealing with fear and greed. Strike prices, this is the price at which you have the right to buy or sell the stock. Now, if you've been around options for a while, you notice that the strike prices that are available have changed over time. If you've been around options and haven't noticed it, this is the most important thing possibly in this section. If you're new, this is possibly one of the most important things in this section. Understand that the strike price choices may change into the future. The old system had preset increments from $5 to $25 every 2.5, and from $25 to $200 every $5, and above $200 every $10. Now the new strike prices, certain stocks will have that preset increment every dollar. Now, this might not seem like a lot to you, but this precision of having the strike prices closer is one of the things that allow us to trade penny-priced options. This did not exist prior to 2010. Now, expiration, options are a fixed-time investment. Options expire. There are numerous expiration choices. Understand the more time you buy, the more money you pay. The standard expiration for options is the Saturday following the third Friday. Saturday following the third Friday. It sounds a little bit confusing, so all we have to think about is the third Friday. Now, all stocks that have options have expirations on this day. There are a handful, currently about 75, recent as March of 2011 of 50, and in July of 2010 when they were first created, just a couple of dozen. But they're adding more and more as we go, and these are stocks that have options that expire every Friday.